Okay, so maybe you have a retirement plan, maybe you've got an investment plan, or shoot, even a financial plan, right? I mean, some of these financial planning softwares, they'll spit out 50-page reports that, I don't know if they say a whole lot, but, it's 50 pages of whatever. But do you have a tax plan? And I think that's probably the most important piece that sort of overlays all of that, right? If you've got a retirement plan, an investment plan, an income plan, a financial plan, sort of over all of that is a tax plan, right? Because the tax man's sort of always there taking his cut. So on this week's episode, we're going to talk about some of the basic structures that you need to have in place in order to have the most efficient, the most effective tax plan for your retirement. Sort of a timely topic this time of year, right? Kind of in the middle of tax season. Maybe you're doing your taxes and saying, wait a second, whew, I'm having to pay a lot in taxes. In addition, everybody's talking about AI, right? And so while it certainly is a great tool, it increases productivity, it allows for very personalized types of answers for you, even involving your healthcare and things like that. Well, the reality is that there's also bad guys, criminals, that are using AI at a frightening pace in order to, unfortunately, steal your money. So we're going to talk about this disturbing trend that clearly isn't going away anytime soon, and what you need to do to recognize the issues involved, and most importantly, protect your money from these scam artists. So welcome on into this week's episode of Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. One of Central Florida's longest running radio programs, also coming to you on a host of podcast platforms as well, where we've been ranked as one of the top 25 financial planning podcasts. So make sure you check us out on that. In addition, you can go to our website at Nelson Financial Planning. If you have any trouble sort of locating our channel on these podcast networks or on YouTube, if you go to our website, you'll see the icons. Click on those and they will immediately connect you. Once you're there, if you hit that subscribe button, then guess what? You don't have to do that process again. My name is Joel Garris, certified financial planner, certified financial fiduciary at Nelson Financial Planning, where we got a team of great folks, all of whom happen to be certified financial fiduciaries as well, that stand ready, willing, and more than capable to help you improve your life with a successful and cost-effective financial plan. So this part of the program, we always like to kind of recap the week, touch on any headlines that sort of popped up over the course of the past week. Looking at some of the more major headlines this past week, we're going to have plenty of topics for future shows. One of the biggest headlines that I saw this past week had to deal with progress in Washington, if we can say Washington has progress, about potential tax changes and kind of getting this big tax bill sort of out of the gate. And so, as always, we're going to wait to see the actual bill that gets passed before we start giving advice. But the reality is we're going to have a lot of juicy topics to cover in the weeks and months ahead, particularly involving taxes. So stay tuned on that. It seems like Washington this past week has sort of pivoted to, okay, now we're going to start to talk about some of the legislation that we're going to pass to implement some of these goals of the new administration. Also, this past week, we were thrilled to be invited to join Simon Conway on his program Good Morning Orlando to provide the latest beneficial ownership interest reporting requirements for small businesses. If you caught last week's show, Rob Field and I talked about that. The injunction got lifted, and so now you got to go through that process of filing these reports with the U.S. Treasury, courtesy of their Financial Criminal Enforcement Network, FinCEN is what that's called. The deadline to do that is March 21. a date that I can remember pretty well because that's my oldest son's birthday. By the way, it's also the weekend of the Winter Park Arts Festival as well. So if you have not been to the Winter Park Arts Festival, been around a long, long time, one of the country's longest running art shows, we encourage you to check it out right here in beautiful Winter Park. More than a stone's throw from the office, but certainly close to our office here in Winter Park. And the 30-day deal in terms of the filing requirement. So basically, the court case that had delayed this thing sort of got resolved to the extent court cases can get resolved on February the 18th. So they said, okay, well, it's 2025, and the rule for filing this beneficial ownership information report for small businesses is that in 2025, you've got 30 days in which to do it. And so, poof, we're going to make the date March 21 in terms of that filing deadline. So I guess I would say, as we were talking with Simon Conway on Good Morning Orlando this past week, I guess I would say, give it a couple weeks, see where this goes, because there's a lot of court cases that are still percolating out there, along with the fact that you could see congressional action on this as well. But best to get organized and get ready. You definitely don't want to wait to the last date to be able to do this because who knows? If everybody waits to the last date, well, then the system might go down if everybody is trying to use the same system. The other comment that I would make, which I think is very important, is that if your inbox is anything like mine, you're getting flooded with emails and things in the mail that are offers, if you will, of folks that are going to help you do this beneficial ownership information reporting. And that's all fine and dandy. But the problem is that with this cottage industry, they're looking to charge you a couple $100 and make that on an annual basis. So they get your credit card and then they just kind of keep running it every year. And, you lose track of that stuff. Everybody does. In this case, I would encourage you to really, unless you want to spend money that you probably don't need to really take advantage of trying to do it yourself. The hardest part of it is, figuring out how to upload your picture of your driver's license, things like that. For Nelson Financial Planning, when I did it, it was a little over 15 minutes. I timed myself. It was 15 minutes and 16 seconds, including getting the picture and all of that kind of stuff. So give it a couple weeks, see how it plays out, but I think might want to start getting organized on that one. And then in other headlines this past week, or should I say this past prior week, February 19th, marked the 5-year anniversary of what many refer to as the COVID crash, if you will. That was the 23-day trading period. So what is that, like 5 calendar weeks? That occurred immediately after major parts of the economy were going to be shut down due to COVID. During those 23 trading days, the S&P 500, which is sort of the broadest market index out there, the one that everybody sort of kind of follows and keeps track of, went down 34% in 23 days. And I guess my comment on that is it's always the thing that you least expect that creates the most amount of short-term volatility. Certainly there's a lot of folks out there that are concerned about the headlines today and all the activity that's happening in Washington, but it's never what you expect, right? If you think back just this year so far, perhaps the biggest impact that occurred in the market had to deal with the development of that Chinese AI model. If you remember that from 3-4 weeks ago now, it was DeepSeek, and that really impacted the market pretty dramatically. So never really what you think it is, right? Side note on how markets have fared post that dramatic COVID crash 5 years ago. Well, in the 5 years since the pre-COVID peak, the S&P 500 has posted an annualized total return of over 14%. Once again, highlighting the importance of staying invested and being diversified and being consistent, which of course is easier if you have a diversified and balanced portfolio. If you think you might not have one of those, perhaps it might be time to have a conversation with us. So visit our website at Nelson Financial Planning to schedule that. With that, we're going to take a break here on Dollars and Cents and return after these messages. So speaking of financial plans, maybe you've got one. Maybe you've got a retirement plan. Maybe you've got an investment plan or an income plan. But there's really no substitute for an actual tax plan, because taxes sort of permeates through all of those kinds of things. And with a tax plan, the goal there is to minimize as best as possible, when you're taking money out in retirement, to minimize the tax bite on those withdrawals. So each type of account that you have has different tax rules, along with different rules on accessibility as well. So it's important to know some of the fundamentals in order to make sure that you don't pay more in taxes than you need to, and to make sure that you are effectively utilizing the assets that you have in order to generate the proper level of income in retirement in a most efficient and effective way possible. So there's 4 steps we're going to outline here in this segment of the program in order to kind of start to set the foundation for really creating that solid tax plan. So the first step in creating that tax plan is to start with an understanding of the mix of the types of accounts that you have. And generally, you want to divide those into 3 different categories. So there's taxable accounts, there's tax-deferred accounts, and there's Roth accounts. Now, taxable accounts, as the name might suggest, are taxable along the way, right? So taxable accounts are typically funded with after-tax dollars. Any interest, dividends, capital gains, or what have you that's happening in those accounts as you go through year after year, those profits, if you will, are included on your tax return in that particular year. Now, these types of accounts can be like individual accounts, joint accounts with your spouse or someone else, or even revocable trust accounts. So all of those sort of fit into the category of being a taxable account. At the office at Nelson Financial Planning, we refer to those as sort of regular investment accounts, if you will. So that's category 1, if you will. Tax-deferred accounts, as the name suggests, are accounts where the tax implications are deferred until such time as you start to withdraw money out. So these accounts would include things like IRAs, 401ks, 403bs, 457s, all of those types of accounts, whereas you take the money out, you're going to pay taxes on it. The third category is Roth accounts, which are kind of a hybrid of both of those, so to speak, because Roth accounts are funded with after-tax dollars. The growth in a Roth is tax-deferred, meaning you don't have to pay taxes along the way. And then, because those accounts were funded with those after-tax dollars, you get to use them without having to pay any taxes whatsoever when you get to retirement age. So a very unique aspect that is unique to Roths, which goes a long ways towards explaining their overall popularity these days. But don't forget, the key piece on those is that you're funding those with money that you've already paid taxes on. So just kind of be aware of that little caveat. So that's the first step. Identify the accounts, understand the individual mix of taxable versus tax-deferred versus Roths. The second step in understanding sort of your individual tax plan as you are maybe approaching retirement or in retirement is to know the difference or the different tax rates that apply to these different types of accounts. So for a taxable account, right? So that's things like IRAs, 401ks, things like that, those tax-deferred accounts, then that as you take money out, all of that money then is taxed as ordinary income. In contrast, for a taxable account, or what we refer to as a regular investment account, if it generates dividends and capital gains, then those are taxed at a much lower rate than, say, taking a withdrawal from a tax-deferred account, because those tax-deferred accounts, like IRAs, every dollar you take out is going to be taxed at ordinary income tax rates, which are in fact much higher. Now, an important item to note is that if you have a taxable account that is invested in things that generate out interest, so not dividends, not capital gains. So in this case, think like a money market fund or a bond fund or something like that, then that is considered interest. And interest is just like a withdrawal out of a retirement account or a tax-deferred account. Those are all taxed at ordinary income tax brackets. And the reality is, the more income you have, right, in the current tax code, the higher the tax rate is that you pay, because obviously the tax rates are on a graduated basis. And ultimately, the more income you have, then the more of that is taxed at that higher rate. So the concept of your marginal tax rate becomes pretty important, because if you generate any extra income or more income, then the more income you're generating is going to be at your highest marginal tax rate. So what that means is that, let's say you have an extra $5,000 and it's all fully taxable. Well, the reality is that that part is all going to fall in at that highest possible rate. Remember, it's only the amount that is over and into that next tax bracket that's taxed at that particular tax rate. But just know the implications of sort of that extra kicker or extra amount that you might withdraw, taxed at the very highest rate in terms of your marginal tax bracket. Current income tax rates start at 10% and roll on up to 37%. Meanwhile, the tax rate on qualified dividends and long-term capital gains taxed at much lower rates. So for comparison purposes, that tax rate on qualified dividends and long-term capital gains starts at 0%, doesn't get much lower than that, on up to 20%. So if you stop and think about that, 0% tax rate, I mean, right, that's the equivalent of tax-free. So the reality is you don't necessarily need a Roth to get to tax-free income if, in fact, you are having the right income getting generated from your portfolio. Now, you have to be aware of what counts as a qualified dividend. There's a holding period that applies. You can't just buy a stock that's issuing a dividend the next day. There's a holding period that applies. Much like there's a holding period in order to have a capital gain count as a long-term capital gain. That holding period is at least a year. So if it's a year, then it becomes long-term capital gain, subject to these much lower tax rates. Of course, if you don't have a gain and you've got a loss, the loss can actually be used to offset capital gain, and up to $3,000 of it be used to offset ordinary income. So there you can actually use your capital loss to offset income that would typically be taxed at that higher ordinary income tax rate. If you've got more losses than that, well, that's not a good thing, but at least you get to carry them forward to future years. So know the types of accounts that you have, know the different tax rates that apply. And then the third item when you're thinking about your tax plan for your retirement and investments is a lot of people get hung up on, oh, I'm going to have to pay tax on my IRAs or my 401ks as I use that money. They also seem to be getting hung up on this required minimum distribution amount that also applies to those types of tax-deferred accounts. And the reality is that let's not forget when we think about the Roth, that's funded with after-tax money. So if you're just starting out, the reality is that tax-deferred accounts will in fact help you save for retirement, because a tax-deferred account lets you invest all of that money rather than have to pay the taxes first. So, excuse me, we're going to have much more to talk about after these messages. We will continue on Dollars and Cents with Joel Garris of Nelson Financial Planning. talking about the importance of creating a tax plan, right? Sort of a timely topic here in the middle of tax season. We outlined the first two steps in that last segment. So the first one is obviously identifying the mix of accounts that you have. What do you have as taxable accounts, or what we like to think of as regular investment accounts that are just maybe in your name or joint name or trust name? What do you have in tax-deferred accounts? How much in those IRAs, those 401ks, 403bs? And then lastly, how much do you have in Roth accounts? Because each one of those is then taxed differently. And then so that leads us to the second step in creating an effective and efficient tax plan. And that is, okay, well, what are the different tax rates that applies, and what type of income do those tax rates apply to? For ordinary income, so that's withdrawals out of those tax-deferred accounts, it's ranges from 10 to 37%. For income that you get in the form of dividends or capital gains, long-term capital gains, then on those taxable accounts, well, then those are subject to much lower tax rates that start at 0%. That's a pretty low tax rate, on up to 20%. So very different tax rates apply depending upon the type of an account and depending upon the type of income or profit that particular account is making, which now gets us to sort of the third piece of creating this effective tax plan, which is really trying to get past some of the things that I think people get hung up on when it comes to taxes and their retirement. I think there seems to be this consensus of, I'm going to have to pay a bunch of taxes on my tax-deferred account, like IRAs, 401ks, and then on those same accounts, I'm also going to have a required minimum distribution. All true statements, but the reality is that when we think about tax-deferred accounts, those help you save for retirement, right? Because a tax-deferred account will let you invest the entire amount into an account versus an after-tax account where you got to go through the tax grinder first, and then with the money that you have left over, okay, fine, then you can fund a taxable account or a Roth account. The fact that you pay those taxes up front, I mean, you effectively have less money to actually invest in those accounts when you start out. So if you're looking to kind of get started on trying to save for retirement, understand the sort of the bonus kicker that comes with saving on a tax-deferred basis, because you don't have to pay the taxes on the money that you put into that right from the very beginning, particularly like when your budget is tight and you're trying to maximize that out, maybe take advantage of all of your employer match to do it on a tax-deferred basis, then you don't have to pay the taxes on that money. According to a study from Morningstar, just to kind of give perspective on that, assuming a equal investment return, so this study assumed 8% return in both cases, and said, okay, if you put $5,000 in a tax-deferred account, right, then you get the full $5,000 in that account. After 40 years, that $5,000, assuming that 8% return, grows to over $108,000. So that's pretty cool. Now, if you put it in a taxable account or a Roth account, well, guess what? You got to pay the taxes on that. And so now you've got less money invested. And so that less money invested at the very, very beginning only grows to about $85,000. So that's a 25% difference, which if you expand that over the course of all of your savings that you're going to do, it can certainly add up. Now, understand the reality is that is then taxable as you use it. But that's why having a good tax plan is a pretty good idea, is to try and figure out ways to minimize that. I guess I would say I'd rather have you have a solid tax plan with more money than less money in the bank, I suppose, is kind of where I come down on that. The required minimum distribution is another item that, I got the must-take money out. Well, if you're retired, aren't you taking money out of the accounts anyway, right? I mean, there's so many different ads out there that push this notion of, you've got to become tax-free, or, the required minimum distribution is going to be a big number. It's really not. When you do the math, in year one, it's like 3.65% of the account. So if you're retired and, like using your accounts to generate income in retirement, which the vast majority of people do, chances are, if you're doing kind of the standard 4% withdrawal rate kind of concept, you're satisfying your required minimum distribution. So those are some important takeaways, if you will, in order to get to establishing sort of this tax plan. So the first three steps are knowing the difference, right, between the different types of accounts, knowing the different tax rates that apply. And then third, don't get too hung up on the taxes that are going to apply. So once you've sort of done those first three parts, okay, I said there was 4 steps to this. Those first 3 are crucially important. It's time then, once you have all of that information, it's time to transition to the last part, which is actually formalizing your particular tax plan. And here's where you're going to need some software to do it. Because in order to really understand and accurately calculate out your tax picture, you probably need some software to run it. I mean, if you've ever tried to do the calculation by hand on the taxation of your Social Security, I wish you well. I used to do that before, we had all this fancy software and whatnot in the office. And it was like a full sheet. And it had like 20 different steps you had to go through in order to calculate it. So I don't encourage that approach. Having actual tax software really is the way to ultimately get to that fourth and final step of creating an effective tax plan. And certainly that's one of the reasons why over 20 years ago we started a tax preparation service at Nelson Financial Planning that is exclusively reserved for our retired or nearly retired clients to really lean into this tax planning concept, because you can certainly add a lot of value and insight by looking at the actual details of a tax return to determine sort of where to create that greatest efficiency. And in today's world, right, calculating all of that, you probably want to use an actual tax return software. So it's those types of things that we do every day for our clients at Nelson Financial Planning. And I believe really underscores the importance and the value of having a tax plan for retirement. So certainly some important discussions, particularly this time of year as it relates to tax planning. We'll shift gears. This next topic really kind of freaked me out. It should probably freak you out too. These days, of course, everybody's talking about AI and things like that. But the reality is that AI is also being used by criminals as well. And if you've driven the 408 just any time over the past week or so, there's actually, like the signs as you're going through that say congestion ahead, and they pretty much always say congestion ahead. But they are now saying, so congestion ahead comes up, and I'm like, I can see that. A bunch of people around me. But they're also saying, warning about ticket scams and not to click on the text that you got that says, hey, you owe a toll. And that's all part of, unfortunately, what's happening out there with AI. And we're not just using AI, right, to help our productivity and to do things maybe a little bit easier for us, but the criminals are too. And so we've got some concrete suggestions that we're going to be going over with you here on the program in our next segment, because there really is a lot to unpack on this. And this technology is moving very, very quickly, and it is allowing these scam artists to make much more personalized attacks to part your money from you on an illegal basis. So stay tuned with us through the break here on Dollars and Cents with Joel Garris of Nelson Financial Planning for much more on that topic. So yeah, this topic obviously kind of freaked me out the more I was kind of digging into it, and it should freak you out too. We mentioned if you're driving the 408 today, you see these signs and that say congestion ahead, and that's always there. But you also see the other signs that are popping up after the congestion ahead that says don't click on the text that says you owe a toll. And the reality is what's happening there is this is the expansion of AI, and unfortunately not in a good manner. As valuable as AI is in terms of creating personalized information, it's even being used in healthcare to create personalized medicine and personalized recommendations, just sort of across the board. Obviously a very valuable tool, but it's also becoming more and more a valuable tool for the criminal sect as well, because those targets are going to be much more personalized, and they're going to continue to get much more personalized. The FBI recently issued a public service announcement warning the public that criminals are in fact using AI to facilitate financial fraud, and that financial fraud is becoming much more pervasive because these AI-based type scams can be much more targeted and even harder to detect. So in this segment, we're going to share with you some of those trending statistics and tactics that are being used, and most importantly, how you can recognize and protect yourself as best as possible. So obviously a lot of these scams are much more personal in kind of their treatment, because you can take a team of criminals. It used to take them weeks, right, to create websites and social media profiles and things like that. All of that can be now created with AI in a matter of minutes. So with using chatbots and things like that, they can keep the conversation going for a while. In addition to a lot of those types of scams these days, a lot of impersonation things happening out there. Criminals, of course, can use AI to generate audio to impersonate sort of well-known public figures, or even personal relations, personal family members, to elicit illegal payments from you to them. So if you get a call from that loved one asking for money or bail money or car repair money, might not actually be them. It could be a scammer using the process of vocal cloning to help impersonate that individual and gain access to your money. So one of the suggestions that the folks at the FBI make is to protect yourself, consider limiting online access to videos with your voice so criminals can't steal it and ultimately create a vocal clone. It's probably a problem for me with our YouTube channel with years of episodes, but there's another way to tackle it. So one of the FBI recommendations is to create a secret word or phrase to use with your loved ones to help verify their identity on phone calls. So, for example, before agreeing to send some money to your kid for a car repair or bail or whatever, ask them for, okay, what's the secret password? What's the secret phrase? All of that. Now, obviously, don't save that in a folder where people can get access to it. We sort of did it as a group text of, okay, well, what was referring back to something else in the past, and I totally did it as I was preparing for this segment. I was like, well, wait a minute, the Garris family doesn't have this, so we need to do this in order to make sure that my boys and my wife are protected, because obviously we've got years of videos out there on our YouTube channel. So no doubt you could do a vocal cloning as well. So create that secret password. Take the time, do it today, folks, to create that secret word or phrase or things like that, where you can use that to independently verify that it is in fact the person that you are talking to. Now, as we mentioned at the top of the break, the billboards on the 408 about the ticket scams, that is also part of the changing trend where scammers are using more text messages. Expect less phone calls, more text messages, because people are just becoming more used to text messages than phone calls. And so the criminals know that. So they are following that trend. Here's the statistic between 2020 and 2023. The percentage of scams initiated with a phone call fell from 67% down to 32%. So from 2/3 of the scams all the way down to 1/3 just in that 3-year period of time. Certainly, we've probably all seen those texts, right? Beyond the ones that we get to pay our toll, there's the U.S. Postal Service asking about a delivery issue, or maybe it's from your bank saying, hey, there was something that didn't work and you need to reach out to us. The reality is that as a part of that, there's also a lot of wrong number scam texts, right? Maybe you've got those as well. I know I have. Great to meet you yesterday, or thanks for lunch, or something like that. And so these criminals start to send these texts, and the second you respond, that's where the hook starts to get set. Maybe you're responding just because, you're polite, you're nice, and, this person, maybe they've just got the wrong number, and I'm going to help them out because, if they want to thank somebody or try and connect with somebody, I want to be helpful. Well, unfortunately, in today's world, being polite on a text doesn't really count for anything. More often than not, if it's a random text from a random number, that is a scam. And ultimately, once you start to engage in the conversation, well, then that's what they want. So politeness doesn't count when it relates to random text messages or the stranger that, supposedly accidentally texted you. Yeah. No, it's not. It's a scam. And in that case, you have my permission to be as impolite as possible, because it's all versions of that, right? Some of them are employment related, get this certificate or apply for this job, fill out all of your information. I mean, some of these really will capture a ton of information playing on your where you are, right? I mean, a lot of the social media profiles, particularly on LinkedIn, you can put a little banner on your LinkedIn profile that says open to work. Well, then that means that you're open to work. So what better scam to specifically target you than one that says, we've got this great job. Don't you want to apply for it? Beyond that, a lot of convincing websites that you then create ads that drives traffic to the websites. Once you kind of buy something from the website, okay, great, then they've got your credit card information. So really, to protect yourself on all of this, make sure you're looking closely at the URL of the website you're ordering from or applying to, whatever the case may be. The URL is kind of the words or the letters and numbers that appear kind of in that search bar at the very top of your computer screen. Another tip on all this is to use credit cards. Now, be careful with those because, high interest rate, that's sort of a legal scam by the credit card companies, but that's a different conversation. But the reality is that credit cards do offer a little bit stronger fraud protections than a debit card. So to the extent you're doing something that you might be outside the ordinary course of action, doing it using a credit card might give you a little bit stronger fraud protection. The harsh reality on all this stuff is it affects people of all ages. It's not just if you're old. The reality is that what the statistics show is that people over 60 are in fact fall for less of these scams than younger people. So if you're young, you can still become a victim of all of this. The unfortunate caveat on that statistic is that if you are over 60 and you do get scammed, chances are you're going to get scammed out of a lot more money. So bottom line, be careful. Change your passwords often, and unfortunately don't believe anything you hear or receive unless you're 100% sure it is from a legitimate source. Bit of sad commentary on how we need to live our lives in today's world, but certainly important to be vigilant, particularly with AI now being used by criminals in a lot of these types of efforts to separate your money from you. With that, we're going to wrap it on up and get on out of here. Thanks for listening to this week's episode of Dollars and Cents. If you have any questions about anything we talked about on the program, or if you think we might be able to help you maybe create that tax plan as you're in retirement or approaching retirement, contact us via our website at nelsonfinancialplanning.com. Thanks for listening to this week's show.